Since the market is currently closed as of Sunday, December 14, 2025, we're looking at the final closing data from the last active trading session. SMX, known corporately as Security Matters Public Limited Company, finished the week at precisely 181.71 USD, registering a sharp decline of 31.36 points, or a 14.72% drop for the day. While the trading desk is quiet right now, that red figure on the screen screams a story of volatility that few other equities can match. If you are holding positions or watching from the sidelines, that 14% haircut in a single session is not just a number, it is a psychological test. Most investors look at a stock price of $181 and immediately associate it with stability, legacy, and established market dominance. You see a price tag like that, and your brain instinctively groups it with high-cap tech giants or steady industrial firms. The expectation is that a stock trading at triple digits has earned its way there through decades of compounding revenue, dividend growth, and institutional trust. You expect the boring predictability of a blue-chip asset that you might tuck away in a Fidelity Wealth Management account or a Schwab Intelligent portfolio. But the reality of SMX is violently different. This price is not the result of organic climbing. It is the result of financial engineering known as the reverse stock split. The company recently executed a 1-for-8 reverse split on November 18, 2025, which consolidated shares to prop up the price and maintain NASDAQ compliance. This is a classic example of where the optical expectation of value clashes with the mechanical reality of market structure. When you see SMX trading at 181.71 USD, you are not looking at a stable giant. You are looking at a highly condensed, low-float volatility engine that moves with the ferocity of a penny stock, because fundamentally, the market capitalization behaves exactly like one. The drop of 14.72% we see today is not a correction. It is the natural heartbeat of a stock that has been artificially compressed to stay alive on the main board. To understand why SMX shed over $31 of value in a single session, we have to look at the immediate context of the last few days. Just prior to this drop, the stock had surged significantly, jumping over 45% on December 11th, following news of a successful commercial pilot involving the molecular tracking of recycled cotton. This creates a classic buy the rumor, sell the news dynamic, but with a twist. In the world of high-velocity trading, especially on platforms like the Robinhood app or through active SoFi investing accounts, traders often pile into these momentum spikes looking for a quick exit. When the news hit that SMX had successfully validated its technology to track fiber mixing and fabric formation, the stock went vertical. What we're seeing now with this 14% pullback is the liquidity vacuum that follows such an event. The traders who caught the ride up are cashing out, and because the float, the number of shares actually available to trade, is so low due to the reverse split, there simply aren't enough buyers at the top to absorb the profit-taking. This brings us to a critical distinction in how you analyze this movement compared to something like Tesla stock or Apple stock. When Tesla drops 14%, it usually signals a macroeconomic shift, a massive recall, or a fundamental change in the electric vehicle sector. Billions of dollars in market cap are wiped out, and it dominates the news cycle on every investing site from Bloomberg to Yahoo Finance. When SMX drops 14%, it's often just a Tuesday. The liquidity is thinner, meaning that a relatively small amount of selling pressure can gap the price down significantly. For those of you managing your own capital through individual brokerage accounts, this is the widowmaker zone. The bid-ask spreads on interactive brokers' trading platforms for stocks like this can widen unexpectedly, and if you're using market orders, you might get filled at a price far worse than you anticipated. Let's dig into the actual business, because the volatility often distracts from what Security Matters actually does. The company operates in the physical to digital traceability space. In simple terms, they have developed a technology that allows them to mark raw materials, liquids, solids, or gases, with a molecular marker. This marker can then be read by a proprietary device and logged onto a blockchain. Think of it as a barcode that is chemically infused into the material itself. You can't scratch it off, you can't fake it, and it survives manufacturing processes. This is why the recent cotton news was significant. If you can mark raw cotton, spin it into yarn, weave it into a shirt, and still detect the marker at the end, you have solved a massive problem for the fashion industry regarding ethical sourcing and recycling verification. However, the disconnect between this technological promise and the stock's performance lies in the financials. The reality that forces investors to rethink their bullish thesis is the cash burn. Developing molecular physics technology and blockchain platforms is incredibly expensive. The company has historically run at a significant net loss, with recent figures showing a trailing 12-month net loss in the tens of millions. This is where the tension breaks. The expectation is revolutionary tech, but the reality is dilution risk. To keep the lights on and the labs running, SMX often has to raise capital. This frequently happens through equity purchase agreements or direct offerings, which dilute the value of existing shareholders. When you see the stock drop 14% despite good news about cotton, it's often because the market smells a capital raise coming. Sophisticated algorithms and institutional investors using Fidelity brokerage tools or Interactive Brokers stock trading accounts are constantly calculating the runway, how many months of cash the company has left. If that number gets too low, they sell before the offering is announced. This creates a treacherous environment for the retail investor using the Robinhood app or SoFi Invest. You might see the press release about a partnership with a major plastics manufacturer or a gold refinery and think, this is it, this is the moment. You buy in. But the heavy selling pressure from warrant holders or convertible note holders who are converting their debt into stock and selling it immediately crushes the rally. This is why you often see SMX spike 50% in the pre-market, only to close red for the day. It's a battle between the narrative of future growth and the mechanics of current survival. I want you to pause for a second and look at your own portfolio. How much exposure do you have to high-beta pre-revenue technology stocks compared to stable index funds? Comment below with diamond hands if you're holding SMX through this volatility, or comment watched from the sidelines if you're waiting for the dust to settle. I really want to know if you guys are playing the swing trade here, or if you're in it for the long-term circular economy thesis. Moving deeper into the technical structure, we have to talk about the role of the short squeeze narrative. Because SMX has a low float post-split, it frequently appears on short squeeze watch lists on social media and investing sites. When the cost to borrow shares rises, something you can track if you have a premium Fidelity trading platform account or access to short interest data on Interactive Brokers, traders anticipate that short sellers will be forced to cover. This anticipation drives buying, which pushes the price up, which forces covering, creating a feedback loop. However, unlike the massive squeezes we saw in 2021, these micro squeezes on stocks like SMX are often short-lived. The 14.72% drop we're seeing today suggests that the short sellers are currently in control, or at least they aren't feeling enough pressure to cover their positions at these levels. They're betting that the company will need to print more stock to fund its operations, which would naturally lower the price. Let's switch gears to the sector momentum. The macro environment for SMX is actually quite favorable, which adds to the frustration of the shareholders. Governments around the world, particularly in the EU, are enforcing stricter regulations on digital product passports and supply chain transparency. The Green Deal in Europe effectively mandates that companies prove where their materials come from and how much recycled content is in their packaging. Theoretically, SMX is perfectly positioned to be the compliance engine for this new global standard. If you're using Schwab Intelligent Portfolios to gain exposure to ESG, or environmental, social, and governance trends, SMX is the aggressive, high-risk version of that bet. The expectation is that regulation will force adoption of their tech, but the reality is that industrial adoption moves at a glacial pace. A pilot project with a cotton manufacturer is great, but it's not a recurring revenue contract with H&M or Zara. Until those pilots convert into massive multi-year contracts, the stock remains a speculative vehicle rather than an investment-grade asset. There's also the comparison to the crypto mindset. Many traders who use Robinhood crypto or hold volatile assets in their Fidelity IRAs treat SMX similarly to a token. The tokenization of physical assets, creating a digital twin for a bar of gold or a ton of plastic, is a core part of SMX's pitch. They even have the plastic cycle token. This aligns them with the blockchain crowd. But unlike Bitcoin or